I guess, Oliver, do you want to start?
Yeah, so Oliver here, COO at Blackwood, originally Danish, but I've had a little bit of a weird background. I've lived in 10 different countries, so child of expat kids bouncing around. Maybe there's a couple of you here that can relate to that. Started my career in investment banking, spent around half a decade there in New York, in Geneva, and in Copenhagen. Had a stint as an entrepreneur, fintech founder. And yeah, I'm probably the least educated person in this room. I only did my BBA at ESADE quite a few years ago, so definitely underqualified to be in front of you guys today, but we'll see how that goes.
Cool, yeah, and I was going to say likewise, but somehow ended up getting an MBA and stuff as well, but I've never really been in classes, so congrats on being here. I was more reading up online on what I should say at interviews. But yeah, Danish as well. I grew up in the south of France in Cannes. Primarily missed the weather, but after living in a few different couple of countries as well, and working at BlackRock both in London, Geneva, and New York, decided to quit before getting the golden handcuffs, which is something that you'll all face at one point. So I quit just before COVID. Thought wearing a suit was stupid, so I started wearing flip-flops and thought I would travel a year in South America. I ended up doing 1 month before COVID happening, and I didn't want to fight those big Brazilian jiu-jitsu people, so I ended up on a one-way flight back to Copenhagen, doing an Oxford MBA, which ended up being a very expensive online course due to COVID. And I wrote a book, and then I launched Blackwood at the same time because I was bored. So fast forward, we'll build a VC company, which we're quite happy about. We started out as an angel network. So, I used to raise money for BlackRock's private equity and hedge funds. In New York, I co-led product strategy as a 25-year-old. That was their M&A hedge fund, a team of 11 people, including the 2 assistants. Managing $3 billion. We grew that from 3 to 10 billion in AUM in 18 months, becoming the fastest growing hedge fund in the world. Super fun. Had a crazy, interesting boss that taught me a lot. He used to be a nuclear engineer on a submarine in the Navy, so it was very much military style. I don't think I had 1 day off, I think. It was a Friday in 18 months. But thought I would use that New York vibe to go and build something unique in Denmark, as the competition was a little bit different there.
Yeah, I mean, basically, you started out as an angel network.
Yeah,
right?
What is it that we do today, Oliver?
That's a great question. Let's see if I know. But started off as an angel network. We've now grown it to about 1,500 angels across Europe. And very quickly we realized that instead of just presenting investment opportunities to a bunch of rich people, we wanted to put our money where our mouth was. So raised the fund. We now have the final closing of our first fund, which we did at 22 million euros. We're of course super proud about that. As you can tell, we're not very old, so we don't have a bunch of gray hair to kind of to pitch on the back of. That was primarily Bastian going around and convincing a lot of people that we're crazy enough to do something exceptional. We invest across Europe, so we're pan-European. We truly are pan-European. That's not just a buzzword. We've invested in 23 companies so far. 3 of them have been in the Nordics, and the rest have been in the rest of Europe. We primarily invest across fintech, Web3, and Greentech, which is what we're here to talk to you about today. So today we've made 6 green tech investments. It is truly one of our pillars, and I think just to wrap it up, we're planning on being fully deployed in our first fund by the end of this year. So that also means that we're starting to gear up for our second fund, which we're targeting at around 50 million euros. So it's going to be some busy months ahead of us.
Yeah, for sure. So it's interesting, right? When you launch something like this, and I guess just again taking it a little bit of a step back and a little bit more conversational. We launched Blackwood with essentially 0 direct startup investing experience. We weren't around asking for money and saying, we think we can relate to tech. We think we can relate to younger people launching companies, and we think we can argue for why we should be on the cap table. And fast forward, that's been the case, and it's quite nice because we've spent 4 to 5 years on this already. And it feels like we've been doing this for 25 years. So, it feels good that, we've made some very nice investments that we're quite proud about. And that after Fund 2 we'll also be in a great position to continue hiring and developing the team as well. Let's yeah.
It's maybe just like a practical questions, but how do you start? Like, how do you get the money to start the VC?
Yeah, I had spent all my money on an MBA, so there's a few different ways. Usually, what normal people do is that they build a company in tech. They have an exit. They make at least 10 million euros each, and then they say, okay, we'll put 1 or 2 of our own million euros into this as a GP commitment, general partner commitment, so that we can go out and raise more money. I didn't have that luxury, so again, we started as an angel network. So I convinced one person that I used to work for in Luxembourg, actually, at a private wealth management company. He was the first guy I called. I was walking around in Copenhagen, and I thought, if I just get 100k, 150k euros, I can like buy myself a year, and like maybe hire a part-time student that can help me build this. Made a call. He said yes. I ran home, super happy. I was like, I can finally try and do this. And so essentially for a year and a half, 2 years, we worked pro bono. I thought, okay, what do we need? Well, we need some startups to look at. We need to have some systems in place to be able to screen them and figure out a framework for that. And then we need some investors to send them to that sort of confirm that the startups that we pick are good. And then once we have that, we might have some credibility enough to launch a fund. So for 2 years, it was just a shot in the dark. I hope that we could figure it out. We ended up finding a few startups before they ended up at Y Combinator, which some of you might know, which is sort of one of the best incubators in the world. And once we saw that we could find them before they got accepted there, we thought, okay, we have a pretty cool engine. And so that might become a case study, HBS case study in the future. But what we ended up doing was, I thought, okay, we need some money for the fund. That's non-existing. We need some money in the company that I need to raise as a startup to be able to hire people and actually have the money to pay to get the financial accreditation from the Danish Financial Authority. And so what I did was I prepared a pitch deck of what I thought a fund might look like, and I ended up having 2 meetings during the same day, 2 different billionaires in Denmark. And I said, hey, would you want to commit a few million euros to this non-existing fund? And they said, yeah, sounds cool. And I said, well, if you say yes to this, you might get the opportunity as well to invest and become co-owners of the management company, where I was also raising money. And so they both said yes the same day. And so from zero, like in one day, I had raised like a few €100,000, like 500-600k for the management company. So I got hired people at the same time. I had secured like the first 4 to 5 million euros in a non-existent fund. And they gave us like a year to secure the financial accreditation from the Danish FSA, which was very complex, because we were the first ones to also ask for your VECA license, which is essentially enables you to fundraise from every country in Europe, whereas Danish VC firms are very conservative. They want to raise from Danish locals. We have very big ambitions. We want to become the best, performing biggest in every sector over the next 10, 15 years. So that was quite interesting. And once they were on board, it was a matter of just working like you would do in a startup and knocking on every possible door to raise that cash. So we ended up, over a period of 2 years, getting 68 investors that on average put 350,000 euros each. So anything from 100k, which is the minimum, to 2.5 million euros, just private individuals. So, we also found the 1,000 richest people in Denmark, their physical addresses, and send out like letters with a QR code. We did everything. I mean, we were not gonna let this not work. So it ended up becoming, like in dollar terms, like $26 million, which is a nice size fund for a pre-seed seed fund in Europe, aiming to invest in 30 companies, and especially for zero experience, a team that at the time was under 30 years old on average, and also fundraising in an environment which was the toughest in 10 years because it was 23 to 24. Now it's better. We have a track, we have more experience, and we have great networks. So once we have Fund 2 up in place where there's more demand, and it's the first time we've had actually cold outreaches, which feels great, where they ask to invest rather than the other way around. So, but interesting ride for sure.
But it's a great question because at the end of the day, that's also what we're doing. We're actually building a startup that just invests in startups, right? I mean, so the way that it's run, the way it's been built, the way we're hustling to make it succeed is as if it was a startup in itself, right? And that's also, I think, a lot of what the value that is that we bring to the founders that we back is that intensity, that passion, that need to succeed. When we invest in a company, it's not just, okay, like a lot of the big funds, here's some cash, good luck, right? We need this to work. This is everything, right? And so when shit hits the fan, then we come with a lot more, right? We roll up our sleeves, we'll get in there and really make sure that...
And that's the thing that annoys me with Andrea, because like I would love to speak even more with him, but he started was doing so great that he does that much. but yeah, no. So that's part of the stuff. But let's move on. So
Was there another question here?
Yeah, maybe. How did you manage to move from hedge funds and PEs financing into the VC, like in the tech or VC world, right? Where you have to find good companies quite early on, probably at universities and so on. Like, how did you manage to do this?
Yeah, it's because I thought, listen, I probably wouldn't be able to get a job in a VC because I had zero experience. So I thought I just need to start it myself.
Like, how did you?
Yeah, so then I thought again when I thought, okay, I need some startups. I thought, where are startups? They're probably like I had heard of incubators and accelerators. So actually, the HEC incubator is one of the first I called, and you know I had made a partnership with this one investor who invested in me. He is a multifamily office in Luxembourg. He manages the wealth of 400 wealthy families, and so I just cold called incubators and said, oh, I have a network of 400 wealthy people. Would you want to be a partner of mine and send me some startups? And I thought that was going to be a super hard pitch, but obviously they said yes because they say yes to everyone. But at the time, I thought I really had to sell it. So suddenly I built 100 partnerships with 100 different incubators, universities throughout Europe, and then I had something. Suddenly we had like 100 startups per month, and so that was the starting point. And then we sort of worked from there. So now we also work with. I think every week we interview a new person. We have a newsletter that gets sent out to thousands of investors, but also 600 venture firms in Europe that read our newsletter. So we're really like relationship driven, because our goal is to invest super early and then take that at a low price and ship it on to the next stage, and then it's a little bit less out of our hands. And of course there needs to be some very positive developments between here and there. So we try to be good at that, but also we need the network to, once they have achieved certain KPIs, to send it out to, right? So they can raise the next round. So yeah, it's just a network building game, cold calling, emailing, whatever it takes, and just like logical based thinking, I would say.
But yeah, super cool, guys. I mean, keep the questions coming.
This is slide one. We all rate those questions. Okay. Okay, very briefly, 23 companies, 14 have raised additional capital after we've invested. So far, that has translated into 40 million euros of additional investment from other venture capitalists that also believe in the company. So it sort of shows that we've been able to find companies that other people want to back as well. If you look at between 24 and 25, we just had our annual report done by Deloitte, and I was happy to see that there's been a 5x average revenue growth in the portfolio between 24 and 25. And anything above 2.5 to 3x is sort of a venture case. Anything below that is just not interesting, because the math, as we will see later on, needs to add up as well from a portfolio perspective.
Yeah. Nice. That's a little bit about Blackwood, but I think we're going to give you a quick intro to what venture capital is. So, I mean, again, keep the questions coming. We're going to want to do this pretty dynamically, but I assume all of you know more or less what it is, but it's basically a high-risk form of investing where you invest in very early-stage startups in exchange for equity. So we provide them with some upfront capital so that they can get going. They can get going on hiring some other engineers. They can get going on executing on converting some customers that they have or whatever it is. Basically, as Bastian mentioned, we raise money from LPs, limited partners. Limited partners can be various different things. They can be high net worth individuals, people with a lot of money. It can be other institutions that are pension funds, for example. It can be multifamily offices. It can be corporates. It can be a lot of different things. Basically, we raise a fund from these LPs, and then we invest it in these companies that we mentioned. we're going to go into this in more detail, but the nature of venture investing is that it's a very high risk game. A lot of the cases that we invest in will fail, and if they don't, then we're doing it wrong, because the way that it works is that because so many of them fail, the ones that win need to win big, right? And that just means that it's a little bit more long shots, the investments that we take, because again, it needs to compensate for a lot of these other ones that will not make it or will not return the returns that we need, right? Basically, just to compare a little bit to some of the other kind of investings that you know, public markets, stocks, right? It's much higher risk, but also higher return than that, right? And also compared to private equity. But also the term and the liquidity of the fund is also largely different, right? I mean, when you're in the public markets, you can buy and sell whenever you want. Our funds, or most venture funds for that fact, are 10-year funds. They're closed funds. That means that an investor will commit his capital, and we will basically hold on to it for 10 years. And then that we hopefully will generate a return, right? And just for your information, more or less, I think most venture funds will target around the 3, 4, 5x returns. That's kind of the dream that they're going for. So yeah, I think that's what we wanted to take away here, is that it's really kind of a home run game. So whenever it is that we invest in a company, that needs to basically be able to return 10 times our money, 10 times the investment, or even higher, right? I mean, then when you look at the success cases of Uber and Facebook, I mean, these are generated 1,000 times returns for the different funds, right? And these are the kind of investment cases that we're, of course, searching for, because this is the kind of investment that will not only make our investors very rich, but also Bastian and I very rich, because, and to be truth, that's kind of the point of why we're doing this as well, right?
It's super hard, because it's a little bit like trying to see the future in this crystal ball, right? You might have some very smart people, very good track, but they just fuck it up in the next startup. So you have to just try and do a 360 analysis of everything, and be like a psychologist, mathematician, an economist, a futurist, and do your best. But again, like even Y Combinator, which I mentioned earlier, YC, that is one of the top accelerators and found and invested in all these companies mentioned here, they get it wrong way more than they get it right. And so I think it's depends on which kind of VC you are, and we'll get into that. But essentially, to make the biggest returns, you also need to take the highest risks and essentially go after what you call moonshots. Maybe two people that seem a little off in some way, but like if this works, that is going to be huge. And so you need as well the right team to be able to back that, and the LP-based, investor base behind you to understand what it is you're doing, so they don't just come and blame you afterwards and say, of course, that's a stupid investment. So it's like a balancing act as well in that sense.
Maybe one question. How much, like, percentage-wise, when you do an investment, how much is it actually like deep analysis and metrics, and how much is gut feeling?
Yeah, so for pre-seed and seed, it's 50-50, but I mean, I think we actually, because it's our first fund, there used to be a saying, I think that's outdated now, but you never get fired for buying IBM. There used to be a saying. And so it's like, okay, we want to invest in things where there's also great co-investors. So these also believe in it. We want to invest in things where we have conviction, and we might take a little longer than the average VC, because we actually want to make sure we check all the right boxes. But that also has perhaps a price of not us being able to get into the hottest deals. That doesn't necessarily mean they're the best deals. But the best startup, what is perceived as being the best startups, don't have any trouble raising money. Like they have 20 investor meetings in one day, and by the end of the day, they've raised $5 million with a pitch deck and like 1 month of work. We see that all the time. That's in San Francisco, right? That's a little different in Europe, but so we need a balance, because they might raise $5 million in one day, but that doesn't mean they're going to be right, and they're raising money at like a $30-40 million valuation with a pitch deck and zero work. That means that for us to have a good exit, which is at least 25x, it needs to become a unicorn. It needs to sell for $1 billion, and that's not all companies get there. So the math is like quite complex, and it's really sort of that goes back to how much time you put into it. So we have seen a lot of VCs just literally meet a person, be like, I really love this person. Here's a note on the back of a napkin, for a few $1 million. But we like to be a little bit, do a little bit more due diligence than that.
But I mean, that's the thing. I mean, we see it, as Bastian mentioned, all the time. Where just the big funds, right, who are super famous. They've got the logo. They've got massive funds behind them. They just throw tickets at very quickly at on paper perfect startups, right? But again, it's what we write here. Even YC, they're right more than, or they're wrong more than they're right, just by raw statistics, right? And so that's a little bit the game of venture capital. It's kind of like an I hope I don't get in trouble for saying it's an educated guess, right? Because nobody knows what the future is going to look like. People have opinions, and there's some people that have very strong opinions and are very outspoken about those opinions, but nobody knows. Truly, nobody knows, right? I think a good example is that I guess you guys all know who Sam Altman is, but we've actually interviewed Sam Altman about AI and what the future of AI looks like. And we've also interviewed a guy called Jan Tallinn, who's the founder of Skype, who led the seed round in Anthropic, worth billions of dollars, one of the most well-versed in all things AI, right? These are two of the most biggest experts within AI in the world, without an argument, right? Sam Altman says that AI is going to unlock human potential, it's going to create thousands more jobs, it's going to be the future of solving everything, right? Jan Tallinn is like, AI is going to kill the world. It's going to destroy all jobs. It's going to destroy humanity, and it will take over the world.
I was literally, so I have a daughter that's 2.5, and I was playing with her, and I thought, I have a question about AI. So I was like, I texted Jan Tallinn about and he just said, this is, I think I should, it was like very funny actually, because you're sitting there playing, I was like playing with dolls, right, and like being super involved. He said everything is uncertain, but for planning and prioritization and purposes, humanity is in the end game now. And so you're like, okay, wow. So he literally believes that by 2030, the humanity is going to get wiped out due to AI being a lot smarter and prioritizing itself. And he funded I think the Center for Existence or whatever it's called.
For Existential Crisis in Cambridge, yeah.
And he led the Series A in Anthropic. So it's just interesting. And so we're trying in the middle here. All these VCs have their thesis, they believe in things. We have two of these figures that are saying the exact opposite thing. So why do we think that we're smarter? So therefore, I think it goes from being a belief mechanism to more of a diversification game in some sense. And so I think that's why at least we end up having 30 to 35 companies in the portfolio, where some VCs are super highly concentrated in like 10 to 15.
Yeah.
But I don't think this is. I know it's a high risk asset class, but no reason to make it more high risk, in my view.
Yeah. So that's the thing. There's a lot of very strong opinions out there. A lot of people who think that they have the crystal ball, but trust me, nobody knows. And that's a little bit what we're trying to navigate as well, right? So to come back to your original question, we try to really do as much diligence that we can, but we also know that nobody knows, right? And the world can tangent out to completely different polar opposites of the spectrum, right? So that's why we try to be very strategic in terms of how it is that we play that, right? Cool. Moving on. Basically, here's a little bit of an overview of the different types of stages that you have within, let's say, the whole venture. These are probably buzzwords that you guys have heard before, right? But basically, starting at pre-seed, even before pre-seed, you've got the ideation phase, which is basically, I have an idea. I'm talking to a buddy about an idea, right? There are some people, like Bastian mentioned, that can go out and raise a little bit of money on that. You don't see it all the time. Normally, you want to have a little bit more traction, right? An MVP, as you call it, minimal viable product.
But by the way, like, show of hands, is this too basic for you, or is this fine? It's new? It's good? Okay, cool. Good.
Tell us if this is fucking boring, and then we'll move on.
But if it's interesting.
But I think just to lay a little bit of the groundwork of what venture is, right? Then we have pre-seed. That's, again, where you have your first customers, maybe, hopefully paying customers or pilots, where you're testing out with some potential customers. They're playing around with your product. You're trying to get a little bit of feedback to figure out, okay, what exactly is it that I'm building? Where is the demand for it, right? And then this kind of just moves on to kind of more validation, more customers, profitability, and it kind of moves all the way down, right? Of course, as you move down in the value chain, bigger companies, then the success rate also increases, right? I mean, the success rate of investing in a Series C company is much higher than investing in a pre-seed or an ideation phase. It makes sense, right? They have customers, they have track record, they have actually proof that somebody wants to buy their product, right? As such, the valuations also increase, and also the average size of the round increases. There is a world after Series C. You see it even more now that companies are being held private longer, are raising Series D, Series E, Series F. This is kind of a new phenomenon that's kind of coming up more and more. There's all this instability in the public markets. There's a lot of pressure, a lot of added kind of, let's say, requirements to go public. So a lot of companies are kind of actually, funny enough, staying private longer. But after that, then there's kind of two main routes for a founder. That's either being acquired by PE, by a corporate, or any other kind of exit, or the famous IPO. This is the end game for all founders. Anybody who wants to be an entrepreneur is dreaming about this day. This is the day where they get huge bags of cash and can go chill on the beach. But basically, this is a little bit the value chain. So at Blackwood, we invest here in the top two in pre-seed and seed. We don't go to ideation. That's too risky for us. We prefer to wait a little bit longer, have them test out, have them get their first pilots, their first customers, a little bit of proof, a little bit of traction, as we call it. And then here it starts getting too expensive for us. Again, our first fund's $25 million fund, $26 million fund. So if we always have to start investing in Series A companies, we can do like 3-4 investments and then we're fully allocated, right? So our first fund is pre-seed seed, where we've been following more. As Bastian mentioned, this is the first time we're doing it, so we do like, or we get the comfort in that some of the more established players have also done a lot of due diligence. They also have been around the block a couple times and they kind of see something cool in this. We're always cautious when we do that, but we like to do it. In our second fund, now that we've kind of gotten a little bit more experience, a little bit more blood in our tooth, as we say in Danish, then we are looking to lead more of these investments and have a little bit more of a conviction-based approach, which is also super exciting. Yeah.
Quick question. So you said 25 million fund size, around 30 investments, 35?
Yeah.
Like less than 1 million per ticket?
Yeah.
Do you aim to be majority shareholder, or do you not care at all?
No.
Like, to what extent does it influence your level of involvement?
Yeah.
So usually at all these levels, as you can see the valuation in the average round. So typically, a company would sell between 15 and 25% of the company. So that's the dilution at every round, plus minus. So let's say it's 20%. So if you want to invest 2 million euros at a 10 million euro post money valuation, you need 1 million to own 10%. Our average ticket size is closer to 400,000 euros initial, and then after that we also reserve 30% of the whole fund to double down on the winners, so we avoid being diluted at next rounds. So in total, it's closer to 600k, whatever, but it's 400 initial and then more. So we very rarely are the lead investor, and the lead investor is the one that takes usually more than half the round. So they would put in that million and a half, take half to 3/4 of the round, and then invite a few select VCs, that they think could contribute somehow, or some angel investors as well, top entrepreneurs that could bring clients or whatever into the round. And so that, therefore, it's important as well as a follow investor in most of the cases to have great relationships with other VCs and get invited into these rounds, if you're not the one leading. I hope that answers that.
But it's a great question. That's something that we actually didn't mention so far, and it's a very good point, that venture investing always takes a minority position. When you're raising a round, a venture-backed round, as Bastian said, you roughly dilute yourself 20%. So 20% of the company is being sold to these venture investors. It's not like private equity, right, where they they typically take a majority position, or sometimes even the whole company, right? That's where venture capital and private equity fundamentally differ.
No, actually, you want the founders to continue having a major part of the company to be incentivized. And actually, once that is not the case, then you feel, oh, this is not a venture backable company anymore. Because a VC would go in and say the cap table is all screwed because the founders are not incentivized to work hard enough. So it's kind of a different way of looking at it.
At the end of the day, when you invest, especially this early, we're not buying a profitable company with lots of customers, stable cash flows. We're buying into the founder. That we're buying into the potential that founder can create something exceptional. So we of course want to have equity, right? Because we want to make money when that becomes huge, and we need to return money to our investors. But at the end of the day, we want to make sure that founder is properly incentivized, so that when he reaches all the way down, he gets diluted these 10, 15, 20% each round, right? That he still has enough of the cake left at the end of the day to have an attractive exit and to be continuing to fight this hard fight, right? It's not easy to create a startup, not easy at all. You constantly have pressure of tight cash flow, you're not finding your product market fit, you're pivoting 100 times, you have no idea what's right or wrong, right? So you want to make sure that when they do succeed, right, in that tiny chance that they make it huge, right, and they make the next Uber, that they also are going to have a nice payday from it. Cool. Moving on, I think we can go pretty quickly through this. We already covered most of it, but this is a little bit more about what Blackwood's investment focus is, right? As we mentioned, we focus on pre-seed and seed. We have dabbled into Series A, but again, it very quickly becomes too expensive for the fund maths to make sense there, right? But that's where we focus. We focus in fintech, Web3, and green tech, as we mentioned, and we are truly pan-European. Again, I want to emphasize that it's difficult to be pan-European, especially when you're that early stage. It's like, again, as Bastian mentioned, it's like, where do you find these startups? Where do they come from, right? And when you are that early on, and it's basically two friends and a computer that are kind of vibe coding with Claude, like, they're not loud. It's not like they're on TechCrunch or Forbes or whatever, right? They're in the basement of their parents' house or in the universities or wherever else it is, right? So it's very difficult to cover so much ground so early on, and that's where, by being a new fund and really have kind of flipped the whole model on its head, and also having those 2 years where Bastian was just basically figuring it all out, we basically built some really cool processes, really cool deal flow pipelines, smart AI tools to basically be able to cover much more ground than before. And I think this is also really one of our competitive advantages about how we can really cover so much ground and actually make the pan-European early stage model possible.
Yeah.
Did I lose people there? No? Cool. All right. The economics of a VC fund. How does VC make money, Bastian?
Yeah, well, good question. So essentially, once you raise a fund, you get investors to commit their capital for 10 plus years. So the good side of that is you take a management fee off that committed capital. So usually it's around 2%. So if you raise a $10 million fund, you're going to have 200K every year for 10 years. You can make that a little bit different. So you might get 250K the first 5 years and 150K the last 5. There's different models of this, so you get a little bit more upfront capital to invest. But that's sort of the average. And so therefore, even with this first $26 million fund, you can do the math and see how much we make a year. The good thing is it's predictable revenue, sort of annual recurring revenue. The bad news is it's actually not that much, right? Because you need huge volumes before it makes sense. So even today, we're actually spending more than we earn, and that's only doable thanks to the other co-owners of the company where we raise some money like a startup. So we can pay people well, and all of our, I think we're 6 full-time, and then 3 or 4 extra people with some gray hairs that have also exited from good companies, and they need some different sort of remuneration. So if you want to do things right, you need big volume. The more interesting part of the revenue side, and also what attracts investors, is the carry. So it's a performance-based share of profits, and often it's 20%. So there might be a little hurdle rate as well, so not to overcomplicate things, but if you have a $10 million fund, you put an 8% hurdle rate that's non-compounding based on the moment of investing. That might end up in being half of the fund that you need to pay back on top of the 10 million before you get your 20%. So in a 10 million fund, if you 5x, that's 50 million. You need to pay the 10 million back plus the hurdle rate of 5, and then you take 20% on the 35 remaining. So if you do a 5x on a 10 fund, you get $7 million over 10 years that you can use to compensate the team. And so
We're gonna quiz you on exactly what he said, so I hope you all understood that.
But
I'm kidding.
But yeah. So so most of the venture funds in the US don't have a hurdle rate. I think Europe don't. As a first-time fund, we needed a hurdle rate, so it's easy to fundraise because people thought, well, you need to perform better than this before. So we went sort of with a hurdle rate for a second fund that'll become a little bit lower. So it's just a market dynamic thing as well. But obviously we're working for the carry because that can become very interesting. With a $26 million fund, if you do a 10x fund, you do the math, and there's a nice little chunk of change for the 6 of us in the team, right? But we also need to work very hard to find the right deals. This 2% is usually just paying for salaries, lights,
So
a little bit of traveling.
it's really here in the carry where the fund manager, Blackwood, for example, is actually going to make their money, right? Again, as Bastian mentioned, this is really just keeping the lights on, paying some salaries, but this is where it gets interesting, and this is also where it's motivating for us to actually make the best investments, right? Of course, we have reputation and all that sort of stuff. You promise investors you're going to do stuff, but if we don't make good investments, we're not going to get any carry. And especially Bastian also, in all those numbers he threw out there, basically tried to say is that this can become quite a lot of money for a team like us, right? And so that's really it.
Yeah, and what's interesting as well, if you look like empirically at the best performing venture funds, is actually the smaller ones. So it's what is called micro funds, or sub $50 million AUM funds, because they're working harder for that carry. Whereas the larger the fund gets, the more, and I've seen that at BlackRock firsthand. Once our fund reached so many billions that the hedge fund manager made many millions just in management fees, suddenly they were less in the office and more on a boat somewhere. So it's just how it works. And so therefore, actually, there's an argument for investing in emerging managers. It's just a higher performing asset class or sector within the VC asset class. That makes sense. And so that's sort of the only argument you got with in the world of fundraising is just looking at historically what makes sense and the incentives behind it as well.
And it's also something that we spend a lot of time also talking about when we're also sizing our second fund now. And sizing is like how big we want that fund to be. It's like, you don't just kind of pull a number out of thin air, right? It's like we need to have a fund. Of course, it's large enough that it's interesting, it's fun. We can make enough investments that we want, that we can execute on that diversified strategy of saying, okay, we want 30, 40 investments in our portfolio, whatever it is that we say. But we want to return 4x to our investors. We want to return 4x to our investors because they're happy, they will give us their money if we can return 4x, but then also we earn a nice bit of carry, right? So then we have to say, okay, a 4x return on the fund, we need to make sure that there are, let's say, enough high-performing companies within that these segments that we're looking at to be able to do that, right? So when you see these mega funds, mega venture capital funds, especially in Europe that have like $500 million, $1 billion venture fund, like I don't get how that actually works because they would basically have to hit every single unicorn that comes out of Europe to be able to return that fund, right? And so that confusion that I have also shows up in the numbers that Bastian was mentioning as well, right? It's because when you then get to that size funds, then they'll start making the 2x funds or the 3x funds instead. They're not going to get for the 4 or the 5x, right? Because again, there's not enough exciting large companies in, especially just Europe, to do that, right? Then you start getting to global funds or American funds, and then all of a sudden that changes a little bit, right? But it's super interesting to think about, like, okay, it's not just about let's raise a $500 million fund, and can we find $500 million? But can we, if we have that money, can we actually make a good enough performance that we can succeed on what it is that our mission is, right? But anyways, I think just to kind of tie this back and why it is that we're explaining, apart from the fact that it's super interesting, it's also important to the founders and the companies that we invest in, because that also determines what kind of companies are venture backable, right? So not every startup can be a venture backable case. We need those companies that have a 10x, 20x, 50, 100x return potential, right? That means they need to be hyper scalable, right? So if someone opens a lemonade stand or a sewage cleaning company or an HVAC company, I mean, these can be fantastic businesses, super healthy profitability, and they can do super well. But it will never be an opportunity for us that we can invest in, as much as we love the founders or whoever else it is, right? Because again, these investments, just by the raw nature of our risk profile of the investments that we do, most of them will fail. So the ones that do succeed need to be able to compensate for all the ones that fail and more to be able to return 4 times the size of our fund back to our investors, right? And if we're assuming that, let's say, 40, 50, 60% of our companies are going to go bankrupt, right? I mean, you guys see the potential, the need for performance of the remainders, right? And the reality is that in most venture portfolios, you'll have 1, maybe 2, in a crazy portfolio, 3, 50 plus X returners, right? But you have those 1 fund returners, as you call them. And that's basically what we're investing in. So when you go and you invest in a company, they have to be a little bit crazy. They have to be radical. They have to change the status quo in an unprecedented way, because if it's just kind of, it's kind of cool companies, software companies that can maybe grow, 3-4 times, that's not going to work for our model. That's private equity or whatever, or an angel investor can go and they can earn 3 times their money back, maybe, right? Good for them. That just won't work in the venture game. And I think it's very important that, we discuss this as well, and because this is, a lot of founders don't realize that when they're pitching venture funds, they don't realize what the need for a venture fund is before they kind of pitch them, right? And so then they get frustrated that venture funds won't listen to them or whatever. But there's just this.
Yeah, and it's so hard to find out as well. You ask these founders also, what's the exit opportunity? I like to ask, would you sell if you got $30 million tomorrow for this? Because they're raising at 10 million, they own 60% of the company. If they literally got an offer for 30 million, they would make 12 million euros each, like in a week. Are you not going to take that? I don't believe it. I would take it probably. And so once you ask those questions, which are a little bit less PC, you get to the real meat of the things. But that's why I meant, when I said you have to be a psychologist as well, is you have to take a bet. And do they mean that they want to become a unicorn and they want to do this their whole life? Because once that offer hits the table, that's a different story, right? So that's an interesting thing. By the way, we need to rush. We have 10-15 minutes to go through these next slides before the case study.
We'll go very quick, but this is basically what it is that I was explaining before. It's called the power law in venture capital, and it's basically, in other words, saying that empirically 6% of all deals result in 60% of all returns in venture, right? Again, just to kind of put it into perspective, the kind of companies that we need to invest in. And basically, the top performing funds, if we look at the data, it's not about being wrong less, it's about being right more. And there's a distinction there, right? If we look here at the data from the 2x, 3x, 3x to 5 and 5x funds, so let's say the better performing funds here, right? These ones look at. You see, this is a different league. You see, this bottom bracket here is the funds that lose more than what it is that we invest in, right? So they lose money. That's more or less the same, right? So all of the better performing, even though the better you get, it's not like you make less bad decisions, right? And that's the name of venture. If you're not making bad decisions, you're doing it wrong, basically, right? Because they need to be crazy. You need to invest in that like weird person that has this crazy idea, is a little bit different, and then basically the real difference is, again, how much of the winners that they get, right? That's where the money is made. It's not made in reducing this, it's made in increasing this. And that just dictates the kind of, let's say, crazy investments that we have to make. Do you want to walk through the
Very
J-curve?
briefly, so essentially, raise some money, there's some fund setup costs, investors lose money because of that. Then you have to take management fees. Then you have to invest, and usually the losers the bad companies perform badly very quickly, lose more money. The investors start calling you and say, what is going on? We thought you were going to make some money. We explain them that that's the J curve and that's how it works. They're like, all right, okay. And then suddenly some of the startups start working and it gets exponential because the fund setup costs have already been paid. Once you reach sort of the 3 to 4 investment period and that's done with, there's less fees for due diligence, with lawyers, tax, whatever, because you've already deployed into the 30 companies, and now it's more about doubling down on the winners. So you sort of spend a lot of money up front, and then the winners win over time.
Yeah, and that's also why it's super important that, for example, first of all the investments that we make are within, say, the investment period, which is within the first 3 years of the 10-year fund, right? And it's important that we invest quickly and early on because of this exponential effect at the end, right? We don't want to have our fund or that particular investment end here, right? When we lose on all this potential on the winners, right? So it really it's the end of the fund life, the end of the 10 years, in year 8, year 9, year 10. That's when it starts to get very interesting for a fund if they have a good portfolio of winners.
And actually, that's why in our LP agreement, LPA, which is a contract that investors sign between us and them, we also say it's a 10-year fund, but we have a possibility to extend by 2 times 1 year. So it's called 10 plus 1 plus 1. So if we see there's still 5 companies in the portfolio and we can always sell them at like a 30% discount on secondary markets, we can extend by a year and say, hey, we might have an actual route to exit and avoid that 30% haircut.
Yeah.
So that's the idea.
Yeah.
Do you know how many funds actually fail? Because now it looks like that all of the funds do this.
No, in VC, that's actually where the asset class where there's the most disparity. So I used to work in the alternatives group at Blackwood, so we were like PE, hedge funds, infra, real estate, all of it. And VCs, the winners do these funds that are 10x, and the losers lose all the money, right? I think that's the hard part. On average, 2/3 make more than 1x, 3/4. So maybe that actually 1/4 of all VC firms actually deliver less than 1x, which is kind of scary. But then, if you look at the top quartile, we're already talking 4x plus, 5x plus territory. And if you look at the top 5%, 10x, 12x. So it's that's why for a first-time fund, you definitely don't want to be down here. But also, are you willing to take the risk necessary to be a top 5% fund, or are you happy with a 4 to 5x fund to show that you know what you're doing, and then double down and take bigger risks as you go? That's sort of more the business mindset behind the fund management role. But yeah, if you just went for the fences and went for that top 5%, you'd take much more risk.
How do the different tasks that you have changed in this time? Like obviously, like in the first place, like you do a lot of calls, like you do a lot of decks, and but then how does it go?
Yeah, and listen, I'm still doing. But so the way we structured it is out of 6 people, it's me and a colleague doing the fundraising. I'm on the sort of the final say as well on the investment team, and then there's sort of the ops, hiring, firing, pay, all this stuff. And so Oliver is our COO and helps with the ops side. I'm more in fundraising and investment. And so in the beginning I was spending much more of my time fundraising. Then now it's actually, I thought, it's investment, but also investment support. So even though we're a follow investor, and my idea was that we weren't going to have to spend too much time helping these companies, because we are who we are and we have a lot of energy and we don't want it to fail. We ended up spending a lot more time than I had anticipated actually helping and supporting these companies, which is also why we have a NPS/Net Promoter Score, which is sort of a satisfactory grading of 94 out of 100 from our portfolio companies, because they're just very happy with the work that we do. So yeah, so it's basically it's a little bit of everything. I think now that we're by end of year or in Q1 next year, we'll be fully deployed in Fund 1 and reach the 30-ish, 32 companies. I also, from next week, will be on the road trying to fundraise our second fund, because we want to reach a first closing for our Fund 2 exactly at the time where Fund 1 is fully deployed. So that is fully deployed, and then we have some money in the first closing that we can start deploying again, so our investment team doesn't just have to sit on their hands and wait.
Yeah.
So that's sort of my job. The next year I'll be finalizing the deployment of Fund 1 and traveling a lot to raise the first 30, 40 million bucks a year for our second fund.
But I mean, generally, like when we also get, let's say, way later in the fund lifetime, and the companies start growing and maturing, they start reaching Series A, Series B, Series C at that point, right? Then all of a sudden, us as a very early investor that has, by the way, gotten probably diluted along the way, what do we own? 2, 3, 4% of the company, maybe, right? That's nothing compared to the other big fish that are kind of have gone in after. So it very much becomes more, let's say, their prerogative to kind of take it over there. They are larger shareholders than us. They are larger funds with larger pockets. And so there is a natural evolution as we get later here where it kind of gets less work for us. It's definitely, let's say, top heavy in the beginning on the workload for us, right?
I mean, we might be able to help with an exit, of course, but again, probably the people who joined later rounds are more qualified. Or more well connected on that front than we would be.
Yeah. We're running tight on time. We have a case that we really want to do with you guys, just kind of give you a real world example. So I think we're gonna maybe just very quickly blast through these. But basically, very quickly.
What we look at, the team is the most important because there's not a lot of numbers yet. The traction, what if there are any numbers, any pilot projects, again. If they've sold their product, 100k euros might seem like a lot if they've done that in a month. If it's taken them 3 years, that's not very impressive. So the traction is sort of a function of money, time, and growth. And then the co-investors in our case are very important as well because we like to co-invest with people that can follow on and double down in later rounds and give support that we can't necessarily do. Every month we look at 500 startups, and by the end of the month we want to do a little less. That was very nice. A little less than.
I was also surprised about that.
Sure you were. We do a little less than one investment. So in 3 years we've done these 24 investments, so 0.7 investments per month. But we do look at 500 every single month. We use AI tools to sort of help us screen this. We source opportunities. We look at the idea. We interview around 100 of these founders every month. So we have a 1-hour phone call, a 1-hour meeting. So we talk to 100 founders every month. And then through the process, we end up making that 0.7 investment.
I think the real just takeaway here is that it's a very, very harsh funnel. We put 1 year a month. The actual real number is under 1 month. So there's a lot of noise. And maybe we miss some great opportunities, but we like to prefer to not make the wrong decisions.
And it's very interesting when somebody says, "Oh, I should take a look at my friend's startup or my cousin's startup," and you're like, "Okay," but I have to tell you, it's it'll be 501. And then if you say no, some people get mad very quickly. So you have to be very good. You have to learn that through the process because in the beginning you're like, "Why is everyone getting mad at me?" So I get a lot of no's from investors. They're gonna get a lot of no's from VCs. That's the world we live in.
Yes.
I have a question. Did you once calculate the cost of doing that process of listening to 500 people? Like, how much does it cost to you to listen to them? Because at the end, if you keep only one, that means that all the work that you have done before costs you a lot, just for one company.
Yeah, a good question. And so that's why we use tech. So even before OpenAI and stuff, so in 2021 we launched. I didn't know how to code, but I asked a smart friend to build me our own natural language processing tools, sort of help funnel, to save time, right? Because the funnel might look like this here, but the real funnel goes like this to this very quickly, right? And so it's about having a lot of conviction in the speed in the original part of the stuff. So we don't speak to 500. That's why we speak to 100. It may seem like a lot. It's 100 hours per month. But again, the average VC stat for these stages, you make one investment out of 100, right? So we just want to look at more. And I think if you can use tech to help you filter that first part, it's not a huge cost. And we believe in finding quality through quantity, rather than just looking at 50 startups. So it is a good balance, good question. It's hard to find, but if I could, with the tech available today, I would love that we screen 5,000 startups a month, even if it costs us one more hire. Because the quality of the outcome, I think, would be exponentially great.
Yeah. But it is something that we're working on continuously, getting better in your tools. But to flip it around, like what's the opportunity cost of not doing it?
Yeah.
Right. If within that 100 we just have that one fund return, I mean that will pay for years worth of 100 hours a
And
month.
actually, like after having looked at 1,000 startups, you also get much smarter about like what to really look for.
Yeah.
In the beginning, you think, oh, they just need to have gone to a good school and say the right things, but like there's so many more things which you learn over time.